Welcome back to Next to Be Strategy channel. We as usual always begin with a disclaimer that says trading in any financial market is extremely risky. You can lose all your capital or more. Please trade at your own risk and do not hold us responsible for any potential loss that you may incur. We are not financial advisors and this is not financial advice. Please consult your financial advisor before you make any trade. Please do not copy, reprint, distribute, resell any of the material that you see here. Now we are going to tap the topic of support and resistance. As everybody in everywhere is talking about support and resistance as demand and supply zones, and we are trying to wipe out that concept for retail traders that there is nothing like demand and supply zone. Support and resistance are always at decimal levels. So whenever we are following any direction towards the support or resistance, we should follow it with at least 4 time frames higher than your trading time frame. Why is it so? That is what you will learn if you learn next to be trained. What are real support and resistance? We know that we are trying to go with the trend, with the direction, and we are trying to chase where the price is likely to go either to the support or resistance depending on the direction. But what are those real support and resistance levels? Support and resistance levels are nothing else but scaled prices at which big bulls and big bears enter the market, enter into that particular instrument or a script. What are those scaled prices? They are stepwise entries of big bulls and big bears. Whenever big bulls try to take the price up in their favor, obviously they don't put all their money in one single trade. They divide their investment into various parts and start investing in that script, looking at whether there is any opposition from big bears that they may experience. If not, then they will put some more money, and all that is done algorithmically, robotically, computerized. And those stepwise entries of big bulls and same way big bears in the opposite direction are called as scaled prices. Bulls take the price up, they scale it up. Bears take the price down, they scale it down. Those scale prices are nothing else but, as I said, entries of big bulls and big bears at decimal levels. So those entries of big bulls at decimal levels form or constitute support. Entries of big bears at decimal levels, whenever there is a downtrend, constitute resistance levels if the price tries to go up or in the reverse direction. So support and resistance created by big bulls and big bears by entering into a market at specific decimal levels are the real support and resistance. Big bulls will try to stop the price at their entry just because if the price drops, they are going to lose money and their investment goes on in hundreds of millions of dollars or thousands of crores of rupees up to that level. So whenever they have entered at a particular level stepwise, investing small portion of their total investment, those decimal levels become the real support levels. If the price drops to those levels algorithmically or computerized or robotic way, the money is pumped in the market to maintain that level so that they can protect their own money. Same way is when the big bears enter the market to protect their money, whatever prices that they scale the price down at, those become resistance levels. If the price goes up and it goes beyond the levels of their entry, obviously the big bears are going to lose money and that loss is humongous. And that is why robotically, algorithmically, again, the prices are maintained at those scaled prices levels, which are nothing else but their entries. So support and resistance are nothing else but scaled level prices where the big bulls or big bears have entered. So they can never be zone, area, or region. They are at a specific, not only a dollar value or rupee value, or it has to be at a decimal level, like $123.63, or whatever those rupees and paise, whatever that may be, it is at a decimal level. It is never a zone, area, or region. So for a retail trader, please remember, demand zone and supply zone do not exist. Support and resistance are just the opposition to your direction or directional trading. If I'm going bullish, who will oppose me? Bears. I need to figure out where the bears are sitting above my entry level, who will try to protect their money and bring the price down. If that's going to happen, and if the price is going to come down, and when I'm bullish, obviously it is going to go against me, it is going to take away some of my profits. So that resistance level where I see big bears entering the market above my bullish entry should be my exit. It is very simple. Most of the retail traders enter at support or resistance levels. That should be your exit, not entry. Your entry is always based on bullish power and bearish weakness, or bearish power and bullish weakness coming together at the same time, as we learned in earlier presentation of this channel. So support and resistance, which are nothing else but bulls and bears entry, which are going to oppose you in your direction, should be your exits and never your entries. So where can you see all of the following? Exhaustion of bulls, which is the power, losing power; exertion, which is gaining power of the opposite force or money; scaled prices, which are stepwise entries of big bulls and big bears; and decimal levels, entries, target, and stop loss. Stop loss and targets are always at resistance and support level depending on your actions, and they are always at a decimal levels, which you can identify on naked candlestick charts. You don't need any indicator. You don't need to put your emotions and news at stake. It is just on naked candlestick chart. Whatever you see on the left hand side, which has already happened, has decided the entries of big bulls and big bears. Whatever you see on the left hand side is going to reflect on the right, which is unseen. So sight on the left dictates vision on the right, and that is the simple formula: is you trade what you see. Don't trade by any assumption or presumption. Just look at naked candlestick chart, analyze them, and that is where you make your decisions. Naked candlestick charts keeps you away from news and views, because news and views are already incorporated in the price, and a candlestick is a graphical representation of worldwide investment in that particular instrument. Indicators being lagging, they will always mislead you in long run. So don't depend on indicators. Because candlestick charts tell you the flow of big money has two duties to perform. One is to grow their money, and second is to protect their money. If you follow the big money, your money will be grown and your money will be protected without having to put any extra money on your part as retail traders. It eliminates emotions and false entries. Why? Because most of the entries of big bulls and big bears are done robotically or algorithmically, where there is no room for emotions. No, there is no room for doubt, fear, hope, greed, and panic. Five evils. There is no room for them. So why should we have, as retail traders, emotions in our trading? We should not. So naked candlestick charts, that is what next to be strategy teaches you about, and it is a unique way to trade with price action. It is not following any usual patterns like double top, double bottom, head and shoulder, cup, saucer, jug handle, flag, triangle, etc., etc. It is just a unique needs to be pattern that needs to be identified, which tells you the precise decimal level entries of big bulls and big bears, and tells you that bulls are in power, bears are weak at the same time, so go bullish or buy. Bears are in power, bulls are weak at the same time, so start shorting. So that is what needs to be strategy is, which allows you to follow the big money. It allows you to tell and define your entries at decimal levels. Exits on both sides, which is our target or take profit, as well as stop loss, are at decimal levels. It also tells you the principles as to why and why not behind every trade or statement that you make in your analysis. So be the master of a strategy, not a slave of the strategy. So needs to be strategy. If you are an intraday trader, swing trader, positional, short-term, long-term, mid-term, or investor. Why? Because every time frame there is big money involved. Small level big money or big level big money. Those big investors, very big money, doesn't care about what happens every minute, every 5 minutes, but at every minute and 5 minutes the price changes. If retail traders cannot change the price, then who does? It is that small level big money. Maybe some pool of money, maybe mutual fund, hedge fund, whatever. It doesn't matter to us whose money is that and what kind of money is that. If there is big bulls and big bears involvement in 1 minute chart, 5 minutes, 15, 1 hour, 2 hours, 4 hours, daily, weekly, monthly, yearly. Only thing, the extent of big money varies from small level to big level. Traders in any market, all the markets, financial markets are driven by big money. Why? Because retail traders cannot do anything to price with their own trading. If you are not consistently profitable, you must learn next to be. If you cannot decide proper entries and especially the exits, anybody can enter, but if you decide and feel that this entry is wrong, what you should do? Next moment you should get out. Next moment you should get out, and that is your exit, that you must know when to get out. So please remember that all markets are driven up and down by big money, and needs to be, that is our methodology, technique, strategy, which analyzes naked candlestick charts to decide and define scaled level prices, specific decimal level prices of entries of big bulls and big bears in the market. Whatever market it may be, it doesn't matter. Everywhere prices are brought up or brought down by big bulls or big bears. So just follow the big money to be successful, consistently profitable in any financial market. So next to be strategy is an ultimate strategy where you learn to earn. Learning is very easy. Gaining knowledge is very easy. What is important is not the knowledge alone, but applied knowledge is the real power. Knowledge is power, but applied, how do you apply it? If you guys, any one of you is a professional, maybe doctor, engineer, lawyer, architect, pharmacist, any profession that you are in, you just see how much of the knowledge and the study that you did to become graduate, masters, or PhD in a particular subject of your profession, and how much you are actually applying to that profession to make money out of it. Doctors may be applying maybe 10%, engineers maybe 10-15%. I do not know. So applied knowledge is the real power, and it is important. One is next to be basics, where we just cover the theory, and there is an interactive session where we learn theory and apply it to some EOD or off live market charts. It's a 1 day course, and that is where you learn the basic principles of next to be what to see and why to see it. And then we have an interactive session where we try to identify those next to be patterns. More importantly, the advanced course, where it teaches you practical application in live market for whatever you have learned. So it is about 12 hours of live market application of next to be. You can earn when you learn. If you want to take a trade, though we do not advise you to take a trade, for the simple reason that for taking trades, entire life is there. Here you are concentrating on how to structure a trade, how to identify entry, how to identify target, and how to identify stop loss, how to define reward to risk ratio, why reward to risk ratio is important, etc., etc. And all that you do on your trading time frame, in your pattern, on your scripts in live market. and that is what is 12 hours of live market training. The ultimate, that is the third part of training, is where we customize training for you. We have a special theory of negation which tells you how to follow the trend, and you sometimes feel that you are out early and the price has gone so much in your favor, but you could not take any advantage of that. And that is what can be eliminated by knowing theory of negation, where you can follow the trend to the fullest. We also customize the trading for you and also teach you a strategy, option strategy, which you can start applying from the same day, and all that we teach again in live market. Another 12 hours of training in live market. So there are three parts of the course: basics, where it is theory and interactive learning for one full day, additional 12 hours at extra fee, which is a practical training with needs to be application in live market, and ultimate course, which is additional customization, options theory with needs to be, and theory of negation, which is a fantastic theory to decide how far the price will go in your favor. So these are the three parts of needs to be strategy training. Contact us for fees and other details. These are the contact numbers for USA and India, the email, as well as the website that is here. We have come up with also a needs to be app, which is currently available on Play Store, and it is currently available for Indian market traders. We'll be shortly coming out with same needs to be app for USA, as well as for forex and for iOS or iPhones. So contact me till then at these numbers or this email address if you want to know more about real, successful, profitable, satisfactory technique or method of trading. That is next to be the ultimate price prediction.